will now provide you with the opportunity to engage with the Monetary Policy Committee of the bank.
Thank you very much again for the opportunity and this engagement. I have a few points I would like to raise, and I found it very interesting that you gave this historical development of the inflation rate. And it peaked in 2009 with 9.5%. If I recall it correctly, during that time, the repo rate was about 8%. So the inflation rate was about 50% higher than currently, and the repo rate was on the same level. And I think it was also this, around that time that the repo rate in Namibia was 150 basis points lower than in South Africa. I'm wondering whether during that time we have witnessed an outflow of foreign currency to South Africa, or whether we could have maybe maintained the spread of 100 basis points with the South African repo rate today in order to lessen the impact on businesses and on households, but also on government finances. Because the interest rate increases has an impact on the budget deficit, most likely, unless government cuts expenditure elsewhere, and therefore on borrowing costs and so on. So therefore, I'm not really convinced that there was a necessity to increase even by 50 basis points, if to increase at all. Secondly, we have seen decline in the inflation rates over the past couple of months. I think from mid of last year until the first quarter of this year, on average, the inflation rate was above 7%. It has now dropped to slightly above 6%. So that might have been already the impact on previous interest rate increases, and there is a time lag. You know probably much better of maybe around a year or more. So if we would have paused and maybe evaluate the impact on going forward on the inflation rate, it would have lessened again the burden on not just the private households and disposable income, but also on business and on government. Then again, it seems sometimes we are still working in silos. You mentioned the administrative prices. I think there is also a need that these institutions collaborate, or maybe you do and consult before these price increases or price changes are being approved. We could have maybe postponed electricity price increases to next year. I'm not sure that it would have had such a negative impact on manpower or on other utilities, in order to lessen again the impact on private households, on businesses, and it could have positive impact on the inflation rate. So I think there is need for more consultations, that we move in the same direction and not in opposite directions. Secondly, you also pointed out construction sector, especially the private part of the construction sector, is very much in negative territory. And that is the part that is influenced by the inflation rate, because the prime rates and so increase, households are less likely to borrow and build and so on. And this is also the part of the construction sector that is labor intensive. So we focus very much always on GDP growth and so, but we neglect the impact on the labor market. And I think that should be our concern. We talk about poverty, about income inequality, job creation. But sorry to say that I don't think that the repo rate increase is supportive of these three developmental objectives. And
my name is Salomo Hay. I represent High Economic Intelligence. Governor, thank you very much. I think for the first time in a very long time, we're seeing that the bank is really wearing the developmental hat or trying to wear it, and it's good for the engagements and the general economy. I've got two questions, and one Klaus actually took out of the third one, but so I've got two, Governor, in the NPC team. The first one is really the core inflation component. I say, Governor, you should sort of just foreshadowed it that it's edging on the upside, but I think we need to start looking at that a bit more carefully, especially for the domestic economy. More so because even on the administrative prices side, what you do see there is, for instance, the telecommunication prices, all those towers and what they use is imported. With that import is the price differential, so there's still an import component of that in relation to the domestic economy. So we should maybe spend a bit of time on core inflation strictly a bit. In terms of the repo rate, I think your hands are really tight. We should perhaps try and speak to the South African Reserve Bank as well. But what I wanted to check with you is, at what point do we start seeing the cost of interest rate, in the sense that you've got the NPLs perhaps increasing to the point that the returns for the banks on their cost of money is being outstripped by this increase on the NPL side? So this could be an inadvertent move. So on the one side, you're increasing interest rates, and the banks derive a return on their cost of money, but because of the unaffordability, the toxic book, for lack of a better word, of the bank is increasing much quicker than the return on the interest rates. And the third one was really what Klaus spoke about in terms of, has there been an impact on the spread that we had from a capital outflow perspective, or was it really because our hand was pushed in order to keep the peg, as opposed to really the capital outflow component? And then just another comment, Governor, that I've picked up in the media around that the banks are not forced, or they don't have to increase when the central bank increase. We must just tread a bit carefully on that front, because if we go into an interest rate cut cycle and we tell the banks that you also don't have to cut, it could be a problem. And ideally what you want to see is really the transmission mechanism still have an impact on when the bank moves, how the commercial banks respond to that. Thank you, Nafika. Thank you, Governor.
Thank you very much.
And I'll take the question on, shouldn't we have paused and kept the 100 basis point differential with South Africa? It's a very good question. One of the reasons why we are currently behind the curve in South Africa is we really wanted to support the economy. And the Bank of Namibia, long before some of us joined in 2002, in 2008, did a paper, Interest Rates and Capital Outflows. And that paper basically concluded that once you get beyond 50 basis points, capital outflows are bound to happen significantly. So what we need to do now is I've asked our research department to update that paper to see whether 50 basis points is still valid. But that is the study that we have got. So what does it tell us now for the first 5 months of this year in terms of capital outflows? So Klaus, we've seen about outflows of 10 billion Namibian dollars for the first 5 months of this year. The same period last year we had 7.5 billion. So you've got about 2.5, 2.6 billion year on year in terms of capital outflows. So we looked at who are actually the sectors that are responsible for these outflows. It was quite clear that asset managers are the ones that are taking money to South Africa. And you can't blame them. They are getting paid for optimizing returns, and that's retirement funds. The others basically was to pay for import bill. So you could see evidence. If you don't close that, you could probably see more and more of that evidence. I wouldn't be surprised if you see more of that. The second one is we need to safeguard the peg arrangements, whether we like it or not. As Mr. Hayes said, we don't have quite, or someone else said, we don't have a choice. That's what we've decided to do. So we also need to be true to the exchange rate regime that we've adopted as a country. So that's on that basis. And also we've seen, yes, inflation is decelerating, and our own forecast is an average inflation of 6.1% for the entire year. You're quite right. So, but we've seen the latest numbers that are coming up, that came out yesterday, from 6.1 to 6.3. So Klaus, looking at all those, we've decided probably to pause would probably be irresponsible at this stage. And based on that, we've decided to increase by 50 basis points. Did you want to tell?
Before I respond to the question on policy coordination, I really fully agree with Governor Klaus. The option of not increasing interest rate in the position in which we were finding ourselves was not really to be going well for the economy. I agree, I think, with your observation that, of course, increasing interest rate has got an impact on people, and people are really feeling it. If you are engaging with people, they will tell you those who were possibly paying their mortgage, say 10,000 per month before the tightening of interest rate, already now possibly they are paying 5,000 more on 10,000, so they could be possibly standing at around 15,000. Of course, that is quite a significant amount, but definitely we need to recognize that we have got a mandate, and our mandate is to ensure that the PEC is protected, and also at the same time to ensure that we have got price stability. So doing nothing, that was not really an option. On the question on policy coordination, it's true. I will admit that we have not really perfected that art. If you attend international conferences, IMF, World Bank, we speak about policy coordination, even among the top countries. It's something that we really speak about it, but eventually, when we get into our own jurisdiction, you first think about your mandate and you first think about your own jurisdiction, even knowing that when you carry out that policy, especially for the larger economies like the US, etc., you know how whatever decision that they will take, the implication of that policy on other jurisdictions. Ordinarily, the coordination is really supposed to take place there, but that art we have not yet affected. I will also not really claim that internally we have affected that. There are areas where we are coordinating in terms of, because we have even structures, Committee on Policy Coordination at the structure of government, Bank of Namibia, Ministry of Finance, National Planning Commission. We coordinate on various policy issues. But I agree that when it comes to issues like dealing with administered prices, because it's all over and it's also in different sectors, I agree that that's an area where we possibly could do better in terms of coordinating that. Again, of course, these are different mandates, different responsibilities, but we know in the economy, things are always interlinked. Whatever happens to one sector has got a ripple effect on the other sector. I will fully agree with you that we can do better on that. Thank you.
On the core inflation, thanks for that remark. And yes, for the MPC, of course, we really do look closely at core inflation. Of course, the core inflation trend has been accelerating, but the level of core inflation currently is very close to 4.5%. So it's not running out of hand. The importance of core inflation being that it gives you an idea of underlying momentum of the inflation process. It's not so much pulled up or pushed down by sudden jumps and developments in things like oil and petrol and diesel prices on the one hand and food on the other. So it's supposed to give us a better indication of the underlying momentum of inflation in the economy. So we certainly look at it and analyze it and worry about it, but with a few footnotes. The one is that the core inflation can be sometimes, unfortunately, below the radar screen when it gets, for instance, to wage negotiations. If it gets to wage negotiations, the negotiators would generally not look at core inflation and say, we recognize that the headline inflation now is 6.3%, but the core inflation is 4.5%. We know that the difference is because of extraordinary short-term circumstances. They will probably reverse, and so the wage demand is only for 4.5%. No, sadly not. Usually in such negotiations, at least on the labor side, the quest is for the highest number, which would be the 6.3% plus something extra, not the 4.5%. So one should be a bit careful not to think that secondary round inflation is based on the core inflation. Unfortunately, that secondary rounds of inflation have a lot to do with the headline inflation rate. Perhaps lastly, could I just mention, with administered prices, sometimes one should be quite careful what you wish for. I remember in South Africa, during the period between 2000 and 2007, I think, Eskom was quite proud to say that they contributed to the lower inflation rate by having quite low tariff increases. Of course, a bit grudgingly also because NERSA, the regulator there, did not give them big increases, but they were then kind of proud to say they contributed to bringing inflation down. Little did South Africa know that the trouble with that would be that you would not leave enough money in the kitty for good maintenance and early action on so many things which later on became really problematic. Of course, on top of that, there was also all kinds of corruption and wrong things at Eskom, but sometimes too low tariff increases in the administered prices field can be a short-term nice thing, and in the long run it can catch up with you. So generally, utilities should not fall back too much. My expectation would be that that would not be such good news. Thank you.
In terms of the construction sector, Klaus, it's true. The construction sector has been in the red for quite some time now. And it has been impacted by two things. There was a period when, I think it's in the 2015s, when we had a a lot of construction activities are taking place in the country, mostly in the mining sector. Now, after that, and those were huge projects. After that, obviously, the base effect kicked in as the years went by. But then also around 2016, we started with the fiscal consolidation policy stance of government, which was a very good policy stance, in my view, because of what it was aimed to achieve. But as we know, with every good thing, there's always something. You try and address one thing, but it will have an impact on another. And this is because usually we have seen that private construction is actually fed by government construction. Whatever happens with the government, that filters through to the private sector as well. And as was indicated during the presentation by Governor, I think we are seeing, in terms of the indicators, government construction-related activities picking up. We have seen that in the developmental budget of government as well. And because private sector is so dependent on government construction, we should be able to see private activities also picking up, and hopefully then going forward, the construction sector's performance might improve. Thank you.
Driven inflation. Demand-driven inflation would have been easier to attack this way and squeeze the incomes. But with the supply-driven inflation, and you're trying to get the economy to move, I think this is a double hit. And if South Africa is going to come down hard, we just tide and fall together. And maybe as I stop, what is within it? I think this is the question of collaboration asked earlier. Shouldn't you be having a seat on the South Africa LPC? And given that they leave us have to follow. And maybe let's stop here.
Allow me also from my side just to make a few comments perhaps. One is, there is empathy for the MPC given the difficult economic environment that we're in. These decisions are not easy and they are not simple. To put the whole puzzle together is a large number of factors. It's not just one, this, one, that, one, that. You have to go on balance and say, all of these things on balance take us to a certain point. So, from my point of view, I think that monetary settings are now appropriate. The lower rate than SA is justified in Namibia, given the very low demand for credit. Credit growth is very weak. We do see a bit of a decline in inflation. My expectation is that the inflation rate by year end will be about 4.6, call it at the midpoint of the unofficial target range. I know the Bank of Namibia does not have a target range as such. And yet my own rough calculation of core is also about 4.5. So on that score, we more or less agree. And then as a side note, just on the Botswana inflation picture, I just can add to the thinking there in that Botswana inflation rate is very heavily sensitive to transport, fuel prices. In their basket, transport is the biggest component. So it's bigger than housing and all the rest. Where in Namibia we used to know that housing is much bigger than any other component. So Botswana inflation really shot through the roof when we had the oil price crisis. And now we're on the other side of the coin where the inflation rate is falling very sharply because with the base effects and all, all that. Just for what it's worth. So you can see that, interestingly, Botswana inflation is similar in behavioristics to that of the US, because the US basket is also very sensitive to energy. That includes fuel prices, gas prices, utilities, etc. So that's one of the reasons why the US inflation rate is also coming down fairly sharply. Yesterday we saw it 4%, which brought the Fed to a pause in the hiking cycle. We'll see what happens going forward. So just a few comments on that. Then also, I think the trouble with being transparent, it is a two-edged sword, because now suddenly people can actually get a hold of the MPC, but previously we couldn't. So people's expectations of what the central bank is supposed to and should be doing is rising. So the Bank of Namibia being a center of excellence in the economic landscape, expectations for it to do more is increasing. So yeah, it would be interesting maybe on your winning hearts and minds comment, how do you think the people generally view the bank, but specifically also the peg arrangement? I think people are starting to get used to central banks generally giving very comprehensive forward guidance. This is not the Fed, the ECB, the Bank of England, the SARB, etc. And the arguments that those central banks use are then brought to the Bank of Namibia to say, why don't you do the X, Y, and Z in terms of your policy? But we forget that the overarching consideration is the fixed exchange rate. In a fixed exchange rate arrangement, you can't do certain things like, let's call it, a free-floating, generally, central bank position. So, how does the people that you talk to perceive the peg, perhaps, and if they are talking about delinking, to what purpose will it be? Will it be to have an even weaker exchange rate, or a stronger exchange rate, or lower interest rates, or higher interest rates? That is the question. What are you trying to achieve if you delink? Yes, now you have independence, but it implies certain things can happen. Then another question, well, just in broad brush strokes, I don't want to harp on the peg too much, but in broad brush strokes, what are the circumstances in which the bank would consider delinking or exiting the CMA or whatever? Because those are the things that we should perhaps be looking forward to. If you think 6 or 9 years down the line, we can earn a huge amount of foreign exchange from oil and hydrogen and all the very nice things we are looking forward to. Just lastly, question, in the MPC's mind, what is the sources of the actual current liquid environment for the banking system in Namibia? Because that's also a consideration. That those things come and go, and we can do certain things now because we're very liquid, but it turns. Thank you.
Let me deal with the first one, and I hope we sort this out and Lord, you understand that. The current peg arrangement serves this country currently pretty well. The benefits outweigh the cost. We are not there yet, but we are thinking about a delinking or a decoupling. So we wouldn't even want to tolerate or engage in a debate that we are thinking along those lines. Anyone else is free to think about that But as a Bank of Namibia, our position is the current arrangement serves this country quite well. We're a small, open economy. We can hardly influence anything, and we don't even think about the conditions of possible exit. You know what that will do to financial markets, Loris? Once you go in and be transparent around that, it's going to cause problems. So we are not there. We are not even thinking about that. So let's get clarity around that. If there's anyone that's uncertain about Bank of Namibia advising the government to consider de-linking, that is wishful thinking. The current arrangement works for this country. So that is our position. Tassius, if we did not defend the peg, where would we have seen the repo? It's a very hypothetical question. We are in a fixed exchange rate environment, so let me deal with that. That's where we see the repo where it is currently. You're saying that South Africa is getting it wrong because it's supply-driven inflation. They're dealing with that, and they're using a demand management tool. Many people say that. That is to some extent correct. But people don't know that the South African Reserve Bank, I'm not a spokesperson for the South African Reserve Bank, but I think when the Fed increases rates and the South African government is ignoring that, you know what's going to happen? The latest figures that I'm seeing is in 2018, foreigners owned 45. In 2018, foreigners owned 42% of South African bonds. Currently, that figure has dropped to 25%. And they were concerned on two counts, because it's not only foreigners dropping South African government bonds, but the financial institutions that are picking them up are the South African banks and South African insurers. So what's happening in terms of concentration risk to the sovereign is an area that they should be concerned about. So they think about that. So they think about capital flows. If the US particularly raises rates and they just ignore that, you'll probably see quite a lot of capital outflows. They probably think about the impact of the currency, although probably that's not the mandate, but they're considering what's the impact on the currency that they have got. And they think about the markets that they have got. So they think about second round effects that they need to manage. They need to anchor inflation expectations. So if they don't do anything, because even in Namibia, I hear everybody is telling us, you're not going to change that. Partially it's correct. If we don't do anything, we're going to see quite a lot of capital outflow from this country. If you don't do that, we are going to put the peg arrangement in jeopardy in our country. So we need to see the bigger picture, rather only looking at what's the source of this inflation that we've got. Let me pause there and ask the one around decoupling we've dealt with. We're not going to talk about, but the other issues colleagues can probably talk about. From you, let's start with yours, and maybe the other members can add to the other.
Thank you very much, Governor. In terms of what we've seen, the sources of the current liquid environment is in the banking system. It's primarily driven by the diamond sales that we've seen, and also the large Namibia Dollar Islamic intermediation. So that primarily was there. But of course, we've also seen that the requirements that were rolled out from the Basel Committee in South Africa for liquidity has caused a situation around the high quality liquid assets. So that had some unintended consequences where you found then that concentration that the government just spoke to. The concentration risk then elevated to the sovereign, which has become a concern in that environment. That's not the case in Namibia. We've also then, as a consequence of that regulation, have held back the rollout of the Basel III liquidity requirements in Namibia because of what we've seen unfolding in the South African environment. But we've seen there the banks, because of that close relationship to South Africa, also doing the same to keep those high quality liquid assets at 100% level in terms of those requirements to align with the parent companies. Thank you very much.
Governor, maybe I can respond to the question. There was one question, that's the easiest one, I'll take that one. Yeah, the question was, does one also really need a seat on the MPC committee at the SARC? My answer to that is maybe we don't need one, because the SARC, from our experience and understanding, is that they're very transparent with how they conduct their monetary policy. So we're able to look at some of the data they look at, they explain it quite well, and it's up to us as a country to keep on looking at whether the PEG arrangement works well. And as the governor has mentioned, this is something that does well on a net basis for the economy. So I don't think we need a seat per se on the MPC. I think we understand how they conduct the monetary policy.
Every 3 months, the governors CMA are meeting. The next meeting is on the 7th of July in Winter. So we can discuss whatever we need to put on the agenda. What we need to understand is they've got a free floating arrangement, and we have got a fixed exchange rate arrangement. The departure point in the premise is different in terms of the final policy making. Yeah, there are similarities, but they are in a regime that's different from ours, although they are down to us. Particularly on the exchange rate side, we've got the ability to influence in a predictable manner.
Maybe just Governor have really touched on the issue of the exchange rate. I mean, I think we, at our next MPC dialogue, we have really put it to rest. Now, there are 2 aspects that are very key when countries are choosing exchange rate, because the choice of the exchange rate is not just an end in itself, but is a means to an end. And these 2 things are: first, competitiveness. Second one is price stability. Now, in the case of Namibia, when you ask yourself that kind of question, given the exchange rate arrangement that we have Namibia lost competitiveness? The question would be no. Have Namibia lost price stability? It's no. Then suddenly this kind of exchange rate confirms, it's not that we are just saying it, confirms suddenly that it's still an appropriate exchange rate arrangement. By the time that we are losing this, we have got issues of competitiveness, we are not gaining on that. Issues of price stability, we are not gaining on that. It's something that can be relooked at. But suddenly when you look at it the way it's structured now, it's very clear, it's transparent to everyone that the current regime works perfectly for the best interest of the country.
Yesterday I was defending the deputy governor on a full-on assault on him based on the increase, but I am an economist, so today I'm going to use the other hand, if you don't mind. So I think fully understand the impossible trinity and the arrangement that we pursue with South Africa in terms of the currency peg, and the fact that because of that, theoretically, we're not able to deviate too much from South Africa's interest rate position. But I've always found it a little bit simplistic, and I think calling it impossible is a little bit incorrect, really. I think it's a difficult trinity, or a tricky trinity of some sort, but it's certainly not impossible. And I've been quite a firm believer in deviating from this when the situation allows for it, or when the situation requires it. And actually, when I worked in the central bank in 2013, there were a number of interesting MPC meetings where, at the time, I felt Namibia should have much higher interest rates than South Africa, when we had very, very accelerated growth, and South Africa was not performing particularly well. So I'm very glad to see that there's an increased willingness to deviate from South Africa now as to what was the case then, and I think that it's right to be able to take those positions when the time allows for it. And I think much like then, one has to ask, what exactly do we think that higher interest rates in Namibia actually achieve? And there are certain things that they certainly do achieve, but there's many other things that they don't. And I think we can kind of summarize the two things that they really have an impact on is domestic demand and potentially capital flows in certain areas. Now, when it comes to domestic demand, there is basically none. Credit extension to households is still very low, well below inflation. We don't really see much demand-driven inflation when it comes to house prices. We don't see much demand-driven inflation elsewhere. And so we don't really see grounds that justify higher interest rates from a demand perspective, and I think that's in line with what the MPC has been saying. The other thing is capital flows, and that's really something where I think that there's a big difference between Namibia and South Africa at the moment that's quite important to take note of. So I completely agree with the governor's summary in terms of why the SARB is hiking, and I think the SARB is still going to hike a lot more. And the reason that I'm going to make the points that I make in the rest of this is because the SARB is likely to hike a lot more, and I don't think that that's very suitable for Namibia. So while I have mixed feelings about the 50 basis point increase that happened now, I think if we chase the SARB for the next 200 plus points, that could be a big mistake for the Namibian economy, and I think that there's potentially a risk of that. So the SARB is definitely hiking to protect the rand. We know why this is. Obviously, many of the things that are purchased in South Africa are oil, food, etc. that's priced in hard currency terms, and with the blowout in the rand versus the dollar, there is some sort of probability of inflation coming through in South Africa, and there is a need to protect the rand and to bring financial assets back into South Africa to do so. Where I want to differ from the MPC is that I don't see the outflows that you're talking about on a net basis in the same way perhaps as you do. Firstly, our hard currency reserves are the highest that they've ever been, and the highest that they've been in the time series that we can get from the central bank, so I presume the highest that they've ever been. And if you look at the bank liquidity position, the liquidity position in Namibia is not abnormally low. It's very much in line with the norm. What is out of the ordinary is the position outside of the country in South Africa. But that's, I think, as DG explained, as Romeo explained, there's a certain number of other reasons for that are perhaps somewhat idiosyncratic, not everyday things. What we see is that demand for assets in Namibia is absolutely astronomical at the moment. We haven't seen the bid-to-cover ratios in conventional debt auctions for many, many years. We haven't seen the bid-to-cover ratios on the inflation-linked bond auctions that we're seeing now for many years. And demand on treasury bills is still very strong. It's not at crazy levels because of the short-term differential between South Africa. But on the medium to long term, the demand for Namibian assets is astronomical. The problem is there aren't enough Namibian assets available for all of this money. So I'm not at all surprised that surplus liquidity is going out of the country into South Africa. And I don't think that increasing interest rates in Namibia does very much in order to attract that back, because really, where does it go? So yes, there's a little bit that can sit in the banking sector, and credit extension is low, but I don't think that credit extension is likely to pick up dramatically overnight and absorb all of that surplus liquidity. It takes time for credit extension to pick up. And I think that higher rates at the moment are not really going to help with this problem of fund flows. I think also, if you look at it, there is so much surplus liquidity looking for a home in Namibia that higher interest rates here are just going to be more costly for borrowers, more costly, being private sector, corporates or government, and I don't really see a huge amount of benefit to that. And if the SARB continues to hike aggressively, again, because of a material sort of outlook differential between Namibia and South Africa, I don't think that we will need to increase rates aggressively in order to retain funds in Namibia and keep the reserve position at the level that allows us to maintain the currency pair. And I think if you just look at the reserves, because of the fact that the rand is relatively weak, which is good for Namibia, oil is potentially on the horizon here, and there's certainly a lot of speculation and interest of foreigners coming to Namibia, both buying financial assets and other assets. And because of perhaps some green hydrogen and other things, there is a potential, I think, big outlook differential between Namibia and South Africa that may require that we have much higher interest rates than South Africa in future. But at the moment, I see no really good reason to be chasing South African rates because of the two factors that our interest rates can influence, and neither of them, in my mind, requires that we have significantly higher rates.
Thank you, Roland. Yes, you do raise valuable and valid points. Of course, one must always be mindful that even if excess demand is not the immediate problem, the indirect price wage spirals that come from the current inflation in its own right have unfortunately a tendency to stick. And so therefore sometimes one is not led by the strength of domestic demand, but rather by the momentum of inflation in its own right in deciding to raise interest rates. So too big a deviation between our interest rates and that of South Africa would be risky stuff. And I think the MPC is mindful of that. There are constraints, but as we have seen, it is possible to deviate without actually in any way limiting the Namibian economy and actually doing things which are more in line with its own domestic needs. But there are constraints to that. In the point that you do not see the capital flows as the MPC does, acknowledge that from your closeness to the market, of course, and we also have our market specialists close to the MPC and on the MPC, so that's very true. What, of course, I'm looking very much forward to see is that strong demand for Namibian assets starts to translate into even much lower interest rates on the long bonds. Those yields are really, for government bonds, really on the quite high side, and one would wish that surplus demand from, I guess, the non-resident sources become translated into a lowering of those costs, which are, after all, for the Namibian taxpayer in the end to pay those interest interest coupons on the Namibian bonds. So thank you. I think that would be my conclusion.
Of course, your observation that if you look at the demand domestically, it may not entirely justify the level of interest rate or the regime that we are following now. I think that's a very good observation. But of course, I think what Johan has said, if I may borrow a word from science, there is a word mutation. Mutation means that anything that is happening has got a tendency to have an impact on other things that are even close by. For instance, even if the inflation is driven more on the supply side, and you think that on the demand side is not a problem, hence you should not do anything, prices has got a tendency of waking up other prices that were even asleep. And they will be awakened. In the moment when they stand, definitely you will see how prices are going to run to the extent that by the time that you're going to wake up as an authority, wanting to tame them, wanting to contain them, they will be out of hand. That's why at any point in time, when you see prices readily ahead, whether it is from the supply side, you know that they have got a tendency trying to bring about mutation to the demand side prices. And definitely that's what we are trying to anchor. With respect to the assets, the flow of capital, I think what you are trying to hint is that, look, we don't have enough assets. And at any point in time, there would be a tendency that any excess that we have will flow out of the country, even depending, irrespective of your level of interest. We need to know that we are finding ourselves in a regime, and sending a message and signal is very key, anchoring the long-term expectations. If you lag behind significantly, it will send a message. And you may not know exactly for how long you are lagging behind. Of course, we may know, but you will not know. And when you are taking a decision, you are not just simply taking a decision, you are trying to take a decision also to manage expectations. Because expectations can influence the economy, either in a positive or in a negative direction. That's why the issue of expectations, even if the reality dictates otherwise, the issue of managing expectations with your policy signal is of utmost importance. And that is basically what we are trying to manage in this process. Thank you, Governor.
Thank you for the questions, Roland. Quite good questions. You started off by the impossible trinity, also you think about difficult trinity. And maybe what we need to bring is everybody on the same page. What the concept basically says is that you can't fix your exchange rate and at the same time have a free flow of capital and have independent monetary policy. At any given time, you can only have two of those. So what we have seen now is if you try and have an independent monetary policy, it has got consequences. And we have seen those. Some of them we can share with you. Some of them belongs to the country we can't share with you. And monetary policy is forward-looking. And the demand question is probably being addressed. I'd like to zoom in on the capital flows one. So, if you think the liquidity is high and the demand for assets in Namibia is so high, so is the question perhaps that you're asking is the right one? I'm asking the following two questions, Roland. Is the lack of market development, capital market development by the economic agents, or do they expect the government, the central bank, whoever to create those so that we can attract that? Or whose responsibility? Johan actually nailed it quite well. He says, we don't see that in the bits. You know, if you believe that, and my own theory would be, is there perhaps a case that, because most of our financial institutions in Namibia are dominated and owned by South Africa, it makes sense to keep assets in South Africa that belongs in Namibia, and it's a deliberate non-development of this market. Is that a case or isn't that the case? I would like to believe there's an element of truth in that as well.
Thank you. Not much. I'm really just repeating what Deputy Governor indicated earlier. And simplify in saying inflation is bad and must be fought. It doesn't matter what the source is. It's not good for growth. It's not good for the vulnerable people. And Klaus talked about perhaps the bank not taking into consideration developmental aspects. I think fighting inflation and pursuing price stability is actually protecting the poor. I'll always repeat that. Thank you.